You've got a trust, an IP trust. That's a discretionary trust. You've got a company, IP Co. Proprietary Limited, and then there are some other private companies involved. Now, IP Trust owns the shares in IP Co. Okay. Now, what happened was that there was a payment by IP Co. up to IP Trust of $10 million. And that was the proceeds of a share buyback. And I'll talk about that more in a minute. But also, there were dividends that were paid from the private company, from these other private companies, and these were fully franked dividends. Also, in the year ended 30 June 2014, there was another company that was set up as a corporate beneficiary, or a bucket company, if you like, of the IP Trust. So it was set up to be a beneficiary of the IP Trust. Now, what happened was that IP Co. bought back the shares that IP Trust owned in that company. And IP Co. paid IP Trust $10 million for those shares. Now, the shares, what constituted that amount in the balance sheet of IP Co. was basically retained earnings on which there were franking credits. Okay? So IP Co. has bought back its shares and it's paid $10 million in consideration. And it has credited the bank and debited the retained earnings as a basic proposition. Now, you may know that when that happens under the tax law, that causes a deemed dividend to arise for the IP Trust. And in this case, fully franked deemed dividend goes up to the IP Trust. Now, here's where the interesting things happen, and this was part of a scheme to split apart the $10 million from its tax implications. So what happened was that the IP Trust, in the year ended 30 June 2014, distributed all of its income for trust law purposes, as defined under the deed, across to this corporate beneficiary. Now, here's the trick. The trust deed was changed. The definition of income was changed to say that the income for trust law purposes was income according to ordinary concepts. Share buyback proceeds are not income according to ordinary concepts. That is a capital amount. And so what you see here is that the IP Trust receives fully franked dividends, apart from this private company of $300,000, but also the $10 million. Now, that's a tax point, okay? So IP Trust has got about $10.3 million of fully franked dividends. But its income for trust law purposes is only $300,000, because that is what is income according to ordinary concepts. I hope that's not too confusing. Now, what that means is that under Section 97 of the 1936 Act, the $300,000 gets pushed across to the corporate beneficiary as the beneficiary who's entitled to the income, trust law income of the trust. But under Section 97, it drags with it all of the tax implications that attach to that amount, which is $10.3 million worth of fully franked dividends. So BE Co gets $300,000, but it gets taxable income of $10.3 million plus the franking credits. And BE Co is a company. It's receiving fully franked dividends. How much extra tax does it pay? Zero. So what we have, folks, if you can see this, is that the actual money the $10 million, is still in the IP trust because it is now the corpus of the trust. But the tax implications that attach to it are dragged across to the corporate beneficiary. And hence, we have a situation where we have been able to split apart the money from its tax implications. And that was the scheme that was involved.